What's shown on the screen now is the Black-Scholes model for option pricing. And the volatility that was found as the implied volatility for a call option with a market price of 2018 was 24.78%. And so what we want to do is now set up a simulation model using that volatility that replicates this market price, because then we can use that model to go forward and price other and value other option strategies. So one of the first strategies we're eventually going to look at is the bull spread. So we'll go to this tab. But first we're going to calculate the call option payoff for the same call option that we used in the Black-Scholes model and see if the simulation model can replicate that. Now, a couple things that are already entered in this model are here an at-risk standard normal distribution, mean 0, standard deviation 1, and the geometric Brownian motion formula for the risk-neutral price. Now, the risk-neutral price is not the price that we expect to actually observe for SPY, but it's the price that would be relevant for calculating options values because there's no downside risk on the option once the option's purchased. We can't lose money on the option. In some cases, we might let it expire worthless and not have an additional gain, but that's the justification for using this risk-neutral price for the option. In a little while, we'll calculate the actual price, but the only difference between simulating the risk-neutral price and the actual price will be this value here that is the growth rate of the stock. B3 is going to reference the risk-free rate when we have it entered here up above. So let's enter these parameters. Mu is the geometric Brownian motion parameter that we estimated for data from SPY. And so it was 11.38%, mu hat. For the sigma, or the volatility parameter, we're going to use the implied volatility from the Black-Scholes model. That's 24.78%. We'll use the same risk-free rate that we used in the Black-Scholes model, which was the 6-month Treasury bill rate, because this option is approximately 6 months. And that was 3.83%. And then the current value of SPY trading at the same time these option prices were obtained was 363.38. Now, initially, we evaluated a call option with a strike price of 380. For some of these option strategies, we'll have multiple options with different strike prices. But in this case, because we're going to replicate the call option that we use with Black-Scholes, we'll put in 380 as the strike price. The time to expiration was 170 days because these are options traded on March 17th or with an expiration of March 17th, and we found that that was 170 days from right now, which is September 28th. So now we can calculate the call option payoff. The call option payoff is the maximum of 0 or the stock price at the expiration date minus the strike price. And then we need to discount this for option pricing purposes at the risk-free rate. And the discount factor is the exponential function of the risk-free rate times the time to expiration. So that will give us our call option payoff. And we'll make this an at-risk output. Now we're ready to simulate this, and keep in mind that the market price of this option was 2018. And so because the Black-Scholes model matches the market price, as long as we use this implied volatility, what we hope to validate here is that this is a valid model for valuing the call option, and so we could use it to value other option strategies as well. So if we run this simulation, what we're finding here is that the simulated option price is 2015, which is very close to the market price of 2018. And this was just using 1,000 trials. Possible we'd even get closer if we use more than 1,000. So what this tells us is we have a pretty good model here for option pricing, and we could use this to move forward and price other types of options and option strategies.